The rapid scaling of artificial intelligence data centers has hit the hard physical limits of the existing electrical grid. Hyperscalers are consuming gigawatts of electricity faster than traditional utilities can build transmission lines, forcing tech companies to secure off-grid baseload power sources. Bloom Energy manufactures the primary hardware used in this effort. Their platform is built on proprietary solid oxide fuel cells that convert fuels like natural gas or hydrogen into electricity on site, bypassing the municipal grid. This technology has attracted significant institutional capital. By the end of 2025, Bloom secured a $2.65 billion supply agreement with American Electric Power to support AI factories and established a $25 billion infrastructure financing framework with Brookfield Asset Management. This chart tracks the stock price response to those catalysts. In months, shares moved from the $40 range to mid-2026 levels around $244.50. This aggressive re-rating assigned the company an implied market capitalization of roughly $68.5 billion. Bloom's transition from a manufacturer of clean tech hardware to a provider for the AI sector has forced a massive repricing of its equity. A $68.5 billion valuation assumes high levels of financial health. However, a review of Bloom's trailing GAAP performance reveals a contradiction. This is an excerpt from Bloom's 2025 10-K filing. Revenue grew 37.3% year-over-year to $2.02 billion, but that growth was accompanied by a GAAP net loss of $87.1 million across its 280.5 million outstanding shares. The market is ignoring these historical cash burns. Current pricing relies on the promise of the forward backlog, creating a disconnect between what the company has achieved and what investors are paying for. To determine if a $244 stock price is justified by underlying economics, we must subject Bloom's financial data to objective stress tests. We will run the company through 4 valuation frameworks: Benjamin Graham's defensive value equation, Warren Buffett's moat and cash flow requirements, Peter Lynch's growth metrics, and a discounted cash flow model. If the data cannot survive these mathematical models, the current valuation reflects speculative interest rather than rational infrastructure pricing. We begin with Benjamin Graham. The founder of value investing required defensive parameters before deploying capital: earnings stability, a record of dividend payments, and a tangible margin of safety. This diagram displays Graham's intrinsic value formula: 22.5 times earnings per share and book value per share. Bloom's 2025 EPS, an $87.1 million net loss across 280.5 million shares, is a negative 31 cents. Inputting negative earnings breaks the model, outputting an intrinsic value of 0. For a value investor following Graham's principles, Bloom Energy offers no margin of safety. Without positive earnings, the company is uninvestable above its liquidation value. Warren Buffett's framework allows for higher valuations if a company possesses a wide economic moat and predictable owner earnings. This timeline illustrates Bloom's primary competitive moat: deployment speed. Using modular blocks, the company can install independent power systems in as little as 50 days. Contrast that against traditional utility providers, where regulatory hurdles and complex transmission builds stretch grid connection timelines to 3 or 5 years. Management has leveraged this speed to secure hyperscale clients, as seen in their deployment at Oracle Cloud Infrastructure data centers. But a wide moat is only half of Buffett's equation. He requires that competitive advantage to generate high return on equity and positive free cash flow. Bloom fails this financial test. Their history is defined by operating losses. Furthermore, management has committed $100 million in capital expenditures to double manufacturing capacity to 2 gigawatts a year. This level of capital intensity prevents immediate owner earnings. Buffett would likely appreciate the deployment speed and the customer base. But the extreme capital requirements and lack of historical cash generation would lead him to reject the stock. Peter Lynch approaches the market differently. Based on 37.3% top-line expansion, his framework places the company in the high-risk, high-reward category of a fast grower. Because Bloom lacks positive earnings, Lynch's preferred price-to-earnings-to-growth ratio is invalid. Analysts using his methods must evaluate the company based on price-to-sales momentum. Lynch looks for institutional validation to support growth. The $25 billion Brookfield financing framework functions as an off-balance sheet engine to finance Bloom's future deployments. While Lynch favors companies riding macro trends like the global AI power constraint, his framework demands that top-line growth eventually yields profits. Operating on narrative momentum and a historic backlog, Lynch might classify Bloom as a speculative buy. However, he would likely note that a $244 entry point stretches the definition of a reasonable price. To find the assumptions required to justify a $68.5 billion market cap, we must rely on a discounted cash flow model. This DCF heat map assumes Bloom scales revenue to $10 billion by 2030, with a 15% free cash flow margin. Even then, the base case ranges from $120 to $150. Reaching $244 requires projecting over 50% annual growth and capital costs below 8%. The math is precise. A traditional DCF model suggests the market is pricing in near monopoly execution over the next decade. At current prices, investors have left no room for error. We can also examine how the market is treating Bloom relative to its peers. This bar chart compares forward enterprise value to sales multiples. Traditional industrial infrastructure companies trade between 3 and 8 times sales. Bloom currently sits at multiples of over 30 times, grouping it with high-margin software-as-a-service companies. A reverse DCF, working backward from the multiple to determine market expectations, reveals the scale of these assumptions. The multiple implies that the market expects Bloom Energy to capture the majority of global incremental power demand generated by new AI data centers. Pricing an industrial hardware manufacturer at software multiples creates a fragile valuation. If manufacturing margins fail to expand, that multiple will contract. The market has priced in the backlog, but Bloom still has to build the hardware. To fulfill the AEP and Brookfield agreements, management must double production to 2 gigawatts annually by the end of 2026. That expansion exposes a supply chain vulnerability. Producing these fuel cells requires significant quantities of raw materials, primarily scandium oxide. Short seller reports have focused on Bloom's reliance on Chinese supply chains for this mineral. The threat of a bottleneck in raw materials has already triggered intraday sell-offs, showing the market's anxiety regarding execution. Hyperscaler demand for off-grid power is high, but Bloom's ability to capture that demand is gated by real-world physics, mineral procurement, and factory throughput. This dashboard aggregates our valuation outputs. The Graham formula outputs 0. The Buffett framework signals a void due to cash flow. Our DCF model yields a baseline of $135. The current trading price is $244.50. The bull case is based on scale. Bloom offers fast deployment speed, enjoys a capital backstop, and has validated its technology through the $2.65 billion AEP agreement. The bear case is defined by risk, supply chain execution threats, negative gap margins, and a lack of valuation safety. Factoring the forward backlog against the valuation premium, the rating is a hold. For value investors, the math does not support an entry point at this level. A mathematical entry point would materialize only after a significant drawdown into the $60 to $80 range. For growth investors holding the stock, the trade is a bet that Bloom Energy procures the materials, expands its factories, and executes its $25 billion pipeline according to current projections.